Hello and welcome to week 7 here with our course, and we're wrapping up pretty quickly here with just 2 weeks left. Again, this week you're going to have a brief forum discussion. Make sure to make a post by Friday and a final post by Sunday. Continue with the learning team homework problems, and wrap up with the group project, paper, etc. Says it comes up pretty quickly here. This week we read chapters 16, 17, and 18, looking a little bit about debt policy, dividend theory, and also kind of projecting out for what we call pro forma statements. Chapter 16, first kind of funny there what they talk about Yogi, about how the pizza should be sliced up, and Yogi says that he's a little bit hungrier today, so I want 8 slices instead of 4. But what they're talking about with the debt policy, and they go into what the Modigliani and Miller's theory is, that in how we structure the debt of the firm, in theory, shouldn't matter. How we slice up the pie, whether we're all equity or all debt. In theory, that shouldn't change the value of the firm and shouldn't change the stock price. Of course, that's just based on efficient markets, and there's no tax implications in kind of a perfect world. But the textbook does recognize that there can be benefits associated with debt, because as we know with debt, we can deduct the interest from the income statement. So it can increase the earnings per share for each shareholder out there. I kind of like to use the analogy of the soup being the net income, the spoons being the stockholders, and the debt bondholders being cups. And if I can have fewer spoons out there by using debt, I can leverage myself and give more earnings per those spoon holders or the stockholders. So what we look at in this chapter is kind of a variation of different potential returns based on how much debt we have. One of the things they talk about in this chapter too is operating risk. That's the business risk. There's a lot of businesses right now that are having to adapt. I think Borders was recently a company closing a lot of its stores. Blockbuster going out of business in certain areas because maybe they were slow to adapt to the internet environment. So, kind of Schumpeter's theory on economies, there's almost like a destructive process that our economy is constantly changing, and if you don't adapt, it's very hard to move on. So companies are constantly having to figure out how to do things. Financial leverage is the amount of debt used. As individuals, we can definitely leverage ourselves, take on more debt than our income. Sometimes it can be used to try to increase our earnings. It can also bring about some risk. And that's what they talk about, financial risk to the shareholders, by the use of debt. Just as you as an individual, if you take on a lot of debt, you put yourself at a greater financial risk if you don't have the income to come up with that money. Second thing in this chapter, I'll wrap up the chapter 16, talks about Eminem's Proposition 2, that the required rate of return on equity increases as the firm's debt-equity ratio increases. So if you kind of look through those examples, and it takes a little bit of time, but if you look on the graphs on page 448, it's kind of saying that as we take on more debt-equity, that equity piece return has to increase in order to kind of maintain that required rate of return. Okay. Well, let's look at chapter 17 here quick. And one of the main things I want to point out in chapter 17, on page 475, they explain the dividend payment process, declaration date, ex-dividend date, record date, and payment date. Essentially, think of it this way. Once the ex-dividend date hits, you are no longer eligible for that dividend. It kind of allows like a 2-day grace period, so you can figure out in the back office, who is actually entitled to this dividend. And then when it's paid, the banks or various offices will kind of shotgun out to all the dividend holders, either through a wire payment or an actual check. But as long as you buy the stock before the ex-dividend, you will receive the dividend, but on that ex-dividend date and after, you're no longer eligible for that dividend. So in theory, the stock price should drop by the amount of the dividend on that ex-dividend date. Different ways we could also pay shareholders. We could have stock dividends that you pay out in the form of additional stocks. I believe the IRS still views this as a form of income and you would be taxed on it. Or a company occasionally will do a stock split. But again, the theory of stock splits is the value of the firm really isn't changing. If you had, say, Sprint stock at $2 a share, and they decided to do like a reverse split of 5 shares making 1 share. You just have 1 share worth $10, but they have done nothing really to change the value of the firm or the prospects going forward. Okay. Another thing that firms can do is stock repurchase. Kind of like the idea of kind of buying back some of those spoons out in the market. Less spoons out there in the market, more soup that can be shared with the existing shareholders, those existing spoons. So it's kind of a way to help them out. Okay. Last thing in this chapter, I want to talk about M&M's dividend irrelevance theory. Again, proposition is under ideal conditions, efficient markets, that just by changing the dividend, you can't change the value of the firm. Again, this makes a lot of assumptions, but the reality is in different markets that there's preferences. There might be those that prefer very high dividends, and we got to remember that most firms don't really pay an increasing dividend. They keep their dividend very low, and will only maybe give an increase in dividend if they feel they can make that happen in the future. So you'll read quite a bit about that, about the theories to wrap up that chapter 17. Last thing in chapter 18, financial planning models. Percentage of sales models is the common theme of this chapter. It's a simple way to kind of project out what our needs are going to be based on what we think the growth is of this company. Some companies are growing quite a bit, others rather stagnant, some even cutting back. But if we are growing at a certain rate, we probably are going to need additional financing. So if we may have to put in a plug that says, hey, yeah, we know we're going to be short of cash. If we need to continue our operations to grow at this rate, we're going to have to raise money by borrowing through a bank, issuing more bonds, going out and issuing more stock. So for now, we just put it in as a plug, and later we'll figure out in what we call the capital markets how we're going to raise that additional funds. They give a nice example of 505 and kind of an example of the executive fruit spreadsheet to go that out into the distance about projecting. And the last thing I want to kind of talk about in this chapter, page 509, they talk about external financing growth. What would that required external financing be based on the growth that we're experiencing? And also, they look at internal growth rate and a sustainable growth rate. These kind of tie into the concept that, hey, if we didn't go out and refinance with any capital, how much could we grow? A lot of that depends on how much of those soup, if you will, if we maintain all our profits, put it back in the company, we could definitely grow a lot more. But they talk about that plowback ratio. How much do you plow back into the company? Okay, well, that's it for this week. So like I said, we only got 2 more weeks left. I'll put 1 more of these videos out there next week. But do send me an email if you have any questions, and have a great week.